So I want to answer the question right now, how does private equity banking really work? Okay? So I went out and I created, by the way, a real illustration inside of the software that I have for getting insurance. In fact, this is a real male that I'm actually working on right now, but I won't use his name. Um, and so I just took his policy. So the numbers you're going to see here, folks, are for a real 25-year-old. Now, I'm guessing nobody on here is 25 years old. And you're going, well, that doesn't fit me. Yeah, you're right. So it isn't. But I think the point and the point can still be made, even though I'm using somebody that's so much younger. Okay, so on day one that you get a private equity banking policy, there are a couple things that happen. The first one is you have to put in premium. Unless you fund this bank, it's never going to work for you, right? On the premium plate, there are two saucers. The first one we're going to call target premium. This is what you usually hear. This is what, when a guy called me, he said, well, I can't afford the insurance. I'm like, dude, don't you understand that part of your target premium is actually buying you cash value? No. Okay, it is. Anyhow, so I put in, this young man said he could put in $1,000 a month. Now I know some of you are out there thinking, crap, $1,000 a month? That's crazy. I'm not going to do that. That's not enough. I want to do 10,000. Or you might be thinking, no, that's too much. I'm going to only put in 100. I don't care what you do with the zeros. Take one off, add one. The ratios are still going to work out. In fact, I got on with somebody the other day. By the way, she's a loan officer. And any of you that want to do this can get your license and work with me on this. And one of the gals that I am working with here at Nexa, she brought me in with a guy by the name of Andy. And Andy got on the phone, and the very first thing he said was, look, Val, I've been thinking about it, and I'm not willing to spend more than another $150 a month on insurance. So just buy me whatever that gets me in death benefit, and let's call it a day. She said, now, Andy, you said you were going to talk to Eric. At least give him half an hour. And he goes, all right. So we start talking. After half an hour, he goes, are you sure I can only put in $15,000 a month? It's because he changed his whole mindset from this is insurance to this is a banking account. So that's what I'm hoping this presentation can show you. But this young 25-year-old is willing to put in target premium of $1,000. Immediately, another plate is filled with cash value of about $600. And then another plate gets filled with death benefit. And in his case, it's $1,790,000. Now, I don't usually talk about death benefit because that's not what this is about for me, and we'll spend most of our time on something else. But I do want to make sure it's clear, incandescently clear, that that is money that's owed to him by the insurance company. If he passed away tomorrow, that's what his heirs would get, 1.7 million. So he put in 1,000, and his heirs would get almost 1.8 million dollars. Okay. Now let's go out to month two. He throws in another $1,000. So now he's got $2,000 in premium, and he's got about $1,200 in cash value, and his death benefit has increased by $2,000. So he put in $1,000, his death benefit increased by $2,000, and he now has available to him, because this is a high cash value product that doesn't have to wait for those restrictions like I was talking about in a typical whole life policy, and the insurance company loan that he can get is $1,200. Now, this is one of the most important concepts here. You'll notice that there's two separate plates, one for cash value and one for insurance loan. What ends up happening here is if he wants to borrow $1,200, which is the amount of cash value he has, it ends up in two separate plates. So let me walk through that. And these numbers are very close to actual. The cash value, most insurance companies that do this, and there's only a handful that do, are currently paying about 5% on the cash value. So you're earning an interest rate that's guaranteed, and most of them are about 5%. And then if you want to borrow money from the insurance company, they're going to pull out another $1,200, and they're going to lend you that. So your cash value never gets taken out of that bucket, that plate. It continues to earn at 5%, but now when you want $1,200 back, you take a loan, and you're probably going to pay about 6%. So let me ask this. if you've got a plate of money earning 5% or 60 bucks, and you got a plate of money that you're borrowing and it's costing you 72, that means that you're really paying 1% net. Loan officers, let me ask you this. Is 1% an excessive interest rate, i.e. usury? Sharon, how many of your lenders at Nexa are willing to loan to your clients at 1% or less?
Sure, none of them.
None of them. And you've got access to the same amount I do, 240 or so, right? So that's the point here, folks. You can now move, if you've got that in there, so again, you've got to fund it, but once it's there, you can use this to fund anything in your life. Okay, so this kid's 25 years old. Let's assume that he has a credit card worth $1,200. What's he probably paying on that credit card? 29%? Chris is shaking his head. Yep. Okay. So at 29%, he's going to be spending on interest 348 bucks. Is 29% excessive interest rate or usury? What do you think, Charlie?
Yeah, it's a lot.
So should he pay off his credit card with an insurance loan if the total insurance loan is only going to cost him 1%?
I mean, he'll be saving a little bit of money on interest. I
Yep.
can guarantee.
Absolutely.
Okay, so both of you say yes. Yeah, in fact, he's only going to pay $12 for that money. That's his cost of money if he borrows it from the insurance company. And so he saved 336 bucks. Now, I'm sure there's some of you going, "Ah, come on, man. 336 bucks, that's no big deal." How much does he really save, you know? But let's add a zero to that. What if he had 12,000 sitting in that cash value account earning 5%? And what if he had available to him $12,000 that he could borrow back from the insurance company at 6% and pay a total of $120, and his credit card was not $1,200 but instead of $12,000? Now that money's cost him $120 and instead of $3,480, right? So now he's saving $3,360. Add a zero to that, and now you're talking a mortgage, right? So that's the idea here, is to fill this thing up so that you can become your own bank as you move forward in life. Let me ask you this. If he paid off that credit card at 29%, are any of you making 28% on your 401k? In other words,
Maybe
this
for a
is
split second of 1 day out of 1 year.
yeah, but that's the whole point, is that most people don't understand that paying off their debts is going to give them a guaranteed return, in this case of 28%, whereas if they stick that money in a mutual fund or whatever, they might get, whatever they're saying, 9-10%. From month two to year one. So at this point, he's put in 12,000 in target premium. He has about 7,200 in cash value. His death benefit is now $1.8 million, and he has 7,200 available for a loan. Let me ask this. With 7,200 in cash value, how much of his lifestyle can he finance? Sharon's shaking her head no. Not much more than a credit card, right? She's like, no, because she wants something more than that. Okay, that's a good point. I'll go with that. Year two. Now he's put in 24,000 in target premium. His cash value is now 14,898. He can borrow up to 14,998, and his death benefit has grown to 1,835,000. So let me ask this question. With 14,000 in cash value, how much of his lifestyle can be financed at less than 1%?
That just all depends on what your lifestyle is, obviously.
Okay, yeah. And again, this kid's now 27 years old, so let's be, realistic. He doesn't have, I don't know, maybe he got out of college and has $150,000 debt, right? But let's go to the end of year three. Now he's put in 36,000. He has 24,000 in cash value, which means he can borrow up to 24,000, right? And his death benefit is now $1.85 million. Notice that there's one thing here. It always grows. It can never go back. So again, with 24,495 in cash value, how much of his lifestyle can be financed at less than 1%? At age
A
28,
down
maybe a
payment on
car?
a house.
Okay, I was thinking more along the lines of a car, but all right. I don't know where 20% is at.
Down payment for a house, like you just said.
Okay, yeah. Well, you guys are thinking like loan officers. That's cool.
And they don't look in there, do they? They don't look that you borrowed from there. It's not a borrowed account. So.
Oh yeah. In fact, Diane and I, as you saw in the picture, we were both jarheads, and we moved into a home here in Texas. How long have we been here now? Almost 3 years, 3.5 years now, Diane. 2.5, 2.5. And we decided instead of getting a VA loan where we could have gotten 100% financed at 4.55 at the time, we put $80,000 down and we pulled it out of our cash value account because I was only paying in my account I was paying 51 basis points, so 0.5% on mine. So yeah, that's what you can do. So year 6, 72,000. Cash value is 58,000. He can borrow up to 58. You get the idea. 1.9 million is sitting in there. Now, the reason I went out to 6 years is so that you could finally see that it takes until year 6 where he puts in 12,000 and he makes in cash value 12,255. Okay? Again, this is a lifestyle. It's not a get rich quick thing. So don't anybody think that that's what it is. And I went to 6 years on purpose for that. Now, what I want to do, okay, with 58,000, how much of his lifestyle can he now finance? And yeah, down payment on a home, buy a car outright, etc. Let's go to year 12. Now he's put in 144,000. He has 145,000 in cash value, which is above, and he can borrow 145. Again, same question. And the cash value, now he puts in 12,000 a year. Now it's growing at 16,040, and he now has over 2 million in death benefit. So again, the same question with 145,000 in cash value, how much of your lifestyle could you finance at less than 1%? He's 37 years old. How many people do you know that are 37 years old that have $145,000 available to them to borrow with? You get the point.
Yeah, but doesn't that also become tax-free money, Eric?
Well, yeah, because he's taking a loan. So if he wanted to borrow that 145,000, he's borrowing it. So if he puts that 145 in his bank account, does he have to pay taxes on it? Is that what you're asking, Chris?
Yeah, exactly.
Yeah. So because it's a loan, he doesn't pay taxes on it. That's why it becomes tax-free. And that's the key when we get into the retirement time is that you can pull these monies out and it's all tax-free. So yeah, good point. Okay. Now I want to go back and introduce, is everybody clear with what I just said? Does anybody have any questions about what I just did in those first 12 years? Clear as mud? All right. Remember I said in the premium plate, there are 2 different reciprocals or buckets, right? The other one is called paid up additions. Now, as I said, a properly structured policy will have this. You should be able to have a paid up additions section. And so what I'm going to suggest is that back in year 1, this young man put in $20,000 into paid up additions. Now the paid up additions is almost 100% savings account if you want to use English instead of insurance speak. Paid up additions in English means savings. So 20 grand. Now wait a minute, he's 26 years old. How much income is he making? Well, the guy I'm talking about right now is making a little more than that, about 60 something, but still, that's almost half of his income. And you're thinking, wow, wait a minute, Eric, this is absolutely crazy. You're saying stick half your income in there? Yes. Why? Because remember back to what Warren Buffett said. We want to learn how to save first and then spend second. And you just saw that saving, everything we put into savings here, or at least from the paid up additions side, ends up going into the cash value. So now he has 26,000 available. He's put in 32 and he has 26 available to borrow from. And the death benefit now is $1.86 million. In other words, he put in 20 here and he gained 55,000 in death benefit. And again, this isn't like homeowners insurance or car insurance that only gets activated if your house has a disaster or if you get in a car wreck. Everyone is going to die, and so at some point in time, his family will get $1.869 million. Okay? This is year one now, if he put that money into the paid up additions. With $26,000 in cash value, how much of his debts can be refinanced at 1%? And I don't want people to think that I'm making something up here. If this young man has student debt, is he paying more than 1% on that student debt? If he has a credit card, is he paying more than 1% on that? You get the idea? So this is how Donja's software is going to work. Is it's going to help you it's going to tell you, hey, pull money out of your cash accumulation account or your private equity banking account and pay off this credit card or pay off this debt. And this software helps you do all that. Okay. So let's go to year 3, 36,000 in target premium, and he's put in 60,000 in PUA. Note how much he has available now. So he's put in 96,000 total, and he has 85,000 in cash value. It's almost even after only 3 years. And the death benefit is now $2 million. Let's say that this young man has 10,000 in credit card debt at 29%, paying $2,900 in interest. And let's say that he has a student loan that's more than 50,000, but he wants to pay off 50,000 of it that he's currently paying 6.5% at. That means that this year, this 28-year-old would be spending $6,150 on just interest. Is everybody with me on that? Sean, Charlie, somebody? Yep. Okay. So that's what he would be spending. And is that untypical for a young man that's 28 years old that went to college? Yeah, Chris is shaking his head. No, of course, that's typical, right? But remember, he now has 60,000 available. Oh, well, he's got 85,000, but I'm going to say he's going to borrow 60 of it. And here's the reason why. I want him to have a positive cash flow, right? So 60,000 at 6%, he's going to pay the insurance company $3,600. But his 85, remember, they never dip into this. This never goes away. They send him money from a different account. His 85,860 is still growing at 5%. That means he's going to earn $4,293 on his cash value. Again, if we subtract 5 from 6, we get 1. So in this case, if he only borrows back 60 of that 85 that he's put away, he has a positive cash flow of 693. And if we add in the 6,150, that young man just put an extra $6,843 in his pocket at age 28.
So you're saying he borrowed the money and he paid 693 in interest, and he saved this 6,150 that he would have been paying if he just kept it with his credit card and the student loan. So his total savings is nearly $7,000.
Yes. Now, let's go back and look at this young man. He's 28 years old. How much is a 28-year-old making? He's out of college. He's got a college degree. He's working. Is $65,000 to $70,000 a year what a young college grad would be making that year, or is it too much?
Probably too much.
Probably too much. Okay. So let's say he was making $68,000 a year. We just gave him what? A 10% raise? Because we put back in his pocket $6,800. And at age 28, he's probably not making $68,000. He might be. But you see how we just put back, we gave this young man a 10% raise at age 28 without doing anything except teaching him to shove his money through there first, save it first, then bring it back out to pay for expenses. All right. Any questions on this? Okay. So now I'm going to kick him out to year 10. He's now 35. He's put through this in target premium 120,000, and he's put through in paid up additions 200,000. So he's put in a total of 320,000 total premium, and he has 355,000 in cash value, which means he can borrow, but he can borrow up to $350,000 at age 35. Folks, what can a 35-year-old do with $355,000 at 1%? Can you see how that can change his life? Right? With 355 in cash value, age 35, how much of his lifestyle can be financed at less than 1%? What keeps most people from becoming entrepreneurs? Anybody?
Cash flow.
Cash flow. Yeah, exactly. Cash flow. And so at age 35, he's been in an industry for, I don't know how many years. Let's say 10, right? He got out of college. Maybe he's got a great idea. Or maybe he just pays for a house, 1%. You know, that's the idea. He's now 45. He's put in $240,000 in target premium. He's put in $400,000 in savings into the paid up additions. So he's put in a total of $640,000 in premium, and his cash value is $916,000. And his death benefit has grown to, where's the number at? 3.5 million. But over that 10 years, he's added almost another $1 million to the death benefit, and he has $916,000 available to him at age 45. I can't tell you what I wish I could have done with $900,000 when I was 45 years old from an investment standpoint. In fact, at that point, Diane and I owned about 16 rental properties. How many of those could we have had free and clear, Diane, if we had had $916,000 at that point in our lives? We had 16 rental properties at that point, but they weren't paid off. I bet you we could have paid off, I won't go into that with you guys, but yeah, Diane and I could have paid off probably 3 or 4 of our properties, because the first property we bought was only $150,000. Well, the first one I bought was $130,000. So yeah, we could have paid off a lot of our properties at age 45. All right, 30 years old, age 55, target premium, he's put in $360,000. And I want you to see something here. The PUA, I had to stop that at age 20 because the IRS would have called this policy a modified endowment, which in English means it's taxable. So he's no longer allowed to put in any more PUA. Put it in for the first 20 years, and after that he had to stop. So no more PUA because this thing's going to become a taxable entity. Again, the IRS has sanctioned this as long as it waddles and quacks like an insurance policy and not like a savings account. So that's one of the things that I do. I have to make sure that the policy you get conforms with IRS guidelines, right? So he's now put in a total of $760,000. He has cash value of $1.5 million.
Nearly double.
Nearly double. Yep. He now has a death benefit of $4.3 million, and obviously he can borrow up to $1.5 million. Parents, are you seeing why you should get your kids into something like this sooner than later? Anyhow, what would you invest in at age 55 if you had availability of $1.5 million at less than 1%? All right. 40 years into this at age 65, again, target premium, he keeps paying it. PUA, he hasn't been able to put in anything for 20 years, so he's put in $880,000. He has $2.5 million in cash value. He has a death benefit of, and it's dropped, by the way, from $4 million down to $3.6. The reason it dropped, folks, is one of the reasons why we're able to create these accounts that the IRS says are not taxable is because we put in extra death benefit through term life insurance. And after 30 years, that portion fell off. So what you're looking at there at $3.6 million is whole life insurance, 100%. All of it is available. So his death benefit did drop after year 30 because the term has dropped off. But now and that's another reason why we had to stop the PUA, because it no longer fit the guidelines of the IRS. Okay? Back to this retirement thing. He has $2.5 million. And what I'm going to say, and by the way, that $2.5 million is growing at interest of about $120,000 a year. So what would you do at age 65? With zero debt, 2.5 million in cash value, growing tax-free at about 120,000 a year, what would you do at age 65?
Just about anything I wanted.
Okay. What I would keep doing, if it was me, I'd keep putting in that $12,000 a year in premiums, even if I had to borrow it, until I was 75 to let this thing grow. Because look what happens between age 40, and this is where compounded interest is so powerful. Again, his target premiums have ended, or he keeps putting in the target premium, so he borrows that over the next 10 years. Still can't put any more into the savings of PUA. So he's put in a total of $1 million. He has 3.8 million available in cash value, which means, and I'm going to say that he's going to borrow that premium for that last 10 years. He's through working. He just pulls $12,000 out of the cash value to pay the premium, which he's legally allowed to do. And that's what he does for the next 10 years. So that this thing will continue to grow up to 3.8 million. And the death benefit at that point is now 4.88. All right. Now he's at age 85. And what happens at age 85? Well, he quit paying anything in at 70, so he still had only $1 million in there. But just sitting there, no payments at all, nothing went into target premium, nothing went into paid up additions. His cash value has now grown to $5.6 million. His death benefit is at $6 million. And he's pulled out $100,000 a year to live on every year for the past 10 years. So that means $1 million there. Plus the interest, so that makes it $1,066,000. Does that make sense? Am I confusing people here? We've jumped forward 10 more years. I should say he's had the policy 6 years. The last 10 years, he's been borrowing $100,000 a year. If you have no debts, remember what I talked about with the no debt thing in retirement? He's borrowing, to your point that you made earlier, Chris, he's been borrowing $100,000 a year in retirement. How much tax does he pay each year when he pulls out $100,000?
Zero.
Zero, exactly. And if he were working at Walmart as a greeter, how much would he actually have to make then to clear $100,000? I don't know, 135?
Like 50 an hour?
Okay, yeah. So, here he goes. He's got that money. It's coming in tax-free. Now he has to have a debt, right? So he has a debt to the insurance company of $1,066,000 because he's still paying the 6% interest on that over a 10-year period. And finally, at age 85, this young man passes away. Okay, because he had a trust, things of that nature, here's what's going to happen. He's got $6.3 million in death benefit, and he has a loan of $1.6 million because he's been pulling $100,000 out. So what do you think the insurance company did first before they gave his family the $6 million? They paid
Took the
themselves
loan back.
Yeah, they took their loan back. Okay, so what's the net effect to his family?
5.2.
5.2 million, tax-free. All right.
Eric, are they taxed? They're not taxed on it?
They're not taxed on it. No.
Okay.
Death benefits are always tax-free, which is a great, great question, Charlie. It's always tax-free. Now, let's say that he did have that money going to the beneficiary being the trust. Well, his wife now becomes the owner of the trust because she's still alive in my fictitious, 60 years into the future example. And what this trust says is that he has to take a stack of $1 million. What she needs to do when she gets this money is put $1 million on kid 1, another $1 million into kid 2, and another $1 million into kid 3. of their 3 kids because they got 5 million available. They had 3 children. Again, I'm just making all this up, but you can see how this is becoming a generational wealth thing. And then grandma, his wife, is told she needs to spend the other 2 million, dividing it up between their 9 grandkids. That other 2 million gets divided amongst all the grandkids, and they all get a policy. And then she is allowed to borrow back out of the cash value whatever she needs to live on. Again, I just made all that stuff up. But that can be done inside of a trust because it can stipulate how that money will happen. So what had they just created for their family? You're on mute, Sharon.
Generational wealth.
Yeah. What were you going to say, Sharon?
Well, for their grandkids,
Oh, and what do you have in your hands? Let me guess. Is that your kid or your grandkid?
my grandkids.
There you go. So that's what they
My
just
LOA.
did. This is your LOA. All right. So you just built a way of creating generational wealth. Now, again, that trust can stipulate things like, you can borrow to buy a house, you can borrow to pay for an education, you can borrow to buy cars. Heck, if you want to take vacations, I don't care. But all that can be stipulated in the trust. So when this gentleman dies at age 85, that trust then dictates to his wife, who's the new owner, how to spend that money. By the way, this is what all of these families have been doing to create generational wealth. The Kennedys, the Roosevelts, the Morgans, the Rothschilds, the Rockefellers, and all of these companies have also done it. Let me ask this. What were you hoping to accomplish in this presentation? Sean?
Well, I just wanted to see what your approach was to the whole idea of private banking.
Okay. Did this make sense for you?
Yeah, no, it definitely does. I do have one little question though.
Sure. Hit me.
So, is that 5% guaranteed year on year, or if we go into a recession and it doesn't go well, does that 5% not happen?
That's a great question, and thank you for asking that. The companies that I work with are all, every single one of them, mutual companies, which means this: there's no stockholders. There are only shareholders. So my policy makes me a co-owner in the company. So at the end of the day, when the company makes money, who do they pay out those dividends to?
Yeah, the stockholders, shareholders.
The shareholders, exactly. And so when you see 5%, like I put up there, figure in today's world, probably 2 to 3% of that is guaranteed, and 2 to 3% of that is non-guaranteed, but a dividend. And the companies that I work with have all been around for over 100 years, and they have always, never, not once, not paid a dividend, even during the recessions of the Great Depression and any other of the 7 or 8 recessions that our country's had in the last 100 years. So they're pretty solvent companies. They invest in things that are very, very conservative, if you will, because they answer to us. Any more questions, Charlie? Sean?
Nope, that'll be all. Thank you so much.
All right, Sean. Look forward to chatting with you again. Charlie?
Eric, thank you so much.
Not a problem. Thanks, folks. Have a great evening.
Yeah, have a better one. See you.
Yep.